Understanding Paid-in Capital, a comprehensive guide. Paid-in capital is a fundamental concept in corporate finance that illustrates how a company finances its operations through equity instead of relying solely on business earnings. In this article, we will explore the nuances of paid-in capital, how it operates within a company's financial statements, its significance, and its implications for investors. What is paid-in capital? Paid-in capital refers to the total amount of cash and other assets that shareholders contribute to a company in exchange for common or preferred stock. This figure is recorded in the shareholders' equity section of a company's balance sheet and is crucial in assessing a company's capital structure. Paid-in capital comprises two primary components. 1. Par value of shares. This is the nominal or face value assigned to a share. It is often a minimal amount, with many companies assigning a par value of just a few cents. 2. Additional paid-in capital. This is the amount that shareholders pay above the par value when purchasing shares. For instance, if a company's share has a par value of $2, but investors purchase it for $20, the additional paid-in capital would be $18 per share. Key takeaways. Paid-in capital reflects the cash or assets received from shareholders in exchange for stock. Components include both the par value of stock and the excess amount paid above par. It serves as a significant source of funds, particularly for startup companies requiring capital for growth before generating consistent revenue. Reporting paid-in capital in financial statements. On the balance sheet, paid-in capital typically has two line items. Common stock represents the par value of all common shares issued. Additional paid-in capital indicates the amount exceeding the par value. For example, if a company issues 2,000 shares of common stock at a par value of $2 and a market price of $20, the total paid-in capital would be $40,000, which is divided as follows. Common stock equals $4,000, 2,000 shares x $2 par value. Additional paid-in capital equals $36,000, 2,000 shares x, 20 to $2. The importance of paid-in capital. Paid-in capital plays a vital role in a company's financial health. Resilience against losses. Young companies often rely heavily on paid-in capital to support initiatives, cover losses, and fund new projects until sustained earnings kick in. Valuation indicator. Investors closely analyze paid-in capital as it reflects their commitments to the company's financial success and can indicate market confidence. Benefits of paid-in capital. Provides a cushion against operational losses and economic downturns. Enhances a company's ability to finance growth initiatives without accumulating debt. Signals investor confidence when companies can attract funds through stock issuance. Types of stock impacting paid-in capital. Various stock types influence the calculation of paid-in capital. Common stock. Common stock represents ownership in a company. While the market value of common shares fluctuates, it does not impact the paid-in capital figure on the balance sheet after issuance. The issuer records the stock at its par value, along with any additional amount paid by subscribers. Preferred stock. Preferred stock functions as a hybrid between equity and debt. It typically offers fixed dividend returns, making it appealing to risk-averse investors. This type of stock can influence a company's paid-in capital but is less commonly issued compared to common stock. Treasury stock. Treasury stock refers to shares that a company has repurchased from the market. This stock is not considered when calculating paid-in capital and is presented as a contra-equity account, thereby reducing total shareholders' equity. If the treasury stock is sold at a profit, the excess is credited to additional paid-in capital. Conversely, if sold at a loss, it reduces retained earnings. Paid-in capital versus additional paid-in capital versus earned capital. While paid-in capital and additional paid-in capital are often confused, it's essential to differentiate them. Paid-in capital, total contributions from shareholders. Additional paid-in capital, the portion of paid-in capital that exceeds the par value. Earned capital indicates profits retained in the business from operations. For instance, a startup might have significant paid-in capital relative to earned capital, reflecting investors' optimism about future growth. Conversely, a mature company should generally exhibit more earned capital, demonstrating reliance on operational profits to fund activities. Recording paid-in capital in accounting. Calculation. Paid-in capital is calculated by adding the par value of all issued shares to the additional capital paid beyond this amount. Entry on balance sheet. Paid-in capital is reported under the shareholders' equity section, denoting a credit entry, an increase, to the capital accounts, and a debit, an increase, to cash when stock is issued. Accounting treatment. Debit, cash or other assets received. Credit, common/preferred stock, at par value, and additional paid-in capital, for amounts above par. Conclusion. In conclusion, paid-in capital is a cornerstone of corporate financing that investors need to understand. It's an essential indicator of a company's financing capability through equity and showcases investor confidence in the company's future potential. While it may not headline the financial statements, it represents an important commitment of resources that can significantly affect a company's growth trajectory and financial stability. By keeping a close eye on paid-in capital, investors can make informed decisions about the long-term viability of their investments.